Good morning, good afternoon, and good evening to everyone joining us for the Group of 30's International Banking Seminar. This is our 36th annual seminar, once again held on the Sunday immediately after the IMF and World Bank's autumn meetings. This time, for the second year running, we are doing this virtually for understandable reasons. And I do want to record our thanks, as always, to the Inter-American Development Bank, which for many years has been hosting us on site at its premises in Washington, and we look forward to resuming that practice next year. For those who are, I think most of the people who are present and invited are very familiar with the Group of 30. For those who aren't, you can connect with us on Twitter at Group of 30. This event is on record, and we have members of the press with us, and we are very happy to have all the major agencies following the event. It is also being live streamed on Bloomberg and other news outlets, as well as our Group of 30 YouTube channel. My name is Tharman Shanmugaratnam. I chair the Group of 30, and I'm joined by Dr. Jacob Frankel, who is the chair of the Board of Trustees of the Group of 30. One more housekeeping detail for participants in our Zoom webinar, and we are very happy to have a very good group of participants with us this morning or this afternoon or evening. Please do submit your questions using the question and answer, the Q&A button on your screen. Depending on what device you're using, the Q&A button is either at the bottom of the screen or the top of the screen. And if possible, please do indicate your name and institution when you do so. So let's go right ahead to the first of two panels we're having as part of this seminar. The first panel is around the theme of the global economy, and particularly the theme of managing uncertainty. We are in a very unusual position where we face a combination of short-term risks, medium-term macroeconomic risks, and more fundamental longer-term challenges that are not just going to occur over the longer term, but are already with us today. It's a very unusual combination of risks. We know we're not anywhere near the end of the current pandemic. A large part of the world's population has yet to be vaccinated, and the very prolongation of the pandemic raises the prospect of new and possibly highly transmissible variants that will affect countries everywhere. So we're not anywhere near the end of the pandemic. But at the same time, we do face a macroeconomic challenge of recovering from the crisis in a way that doesn't build up risks for the medium term. And this is particularly because we are in somewhat new territory as a result of COVID-19 and what it's done over the last 2 years. Our objective is not just to recover demand, but to recover supply. There are supply disruptions that are of a temporary nature, but there's also some degree of uncertainty as to how much of supply capacity has been permanently diminished. And therein lies the challenge for macroeconomic policy to help to recover economies without building up the risks of a overheating economy over the medium term. And then we have the fundamental challenges which are already with us, which are the long-term challenges which are already with us. The challenge of preparing for climate change, mitigation and adaptation, and accelerating efforts to do so. The challenge of reducing the insecurity the world faces with regard to future pandemics. That's a critical challenge that we can't waste time on, we can't delay acting on. And the challenge of addressing issues to do with social mobility, social cohesion, and the domestic problems that many countries face, and this challenge of ensuring that populations are with us as we address both the short-term and the long-term challenges of recovery and preparing for climate change and pandemic security. So it's an unusual combination of risks and challenges that we face, and we have 4 speakers on our panel who are eminently suited to talking about these challenges. We have Christolina Georgieva. Everyone knows Christolina, Managing Director of the IMF. We have Yi Kang, Governor of the People's Bank of China. We have Augustin Carstens, General Manager of the Bank for International Settlements, the BIS. And we have Andrew Bailey, Governor of the Bank of England. They will each speak in that order. Their opening remarks will take up to 8 minutes or so. And we start with you, Christolina. Over to you.
Thank you very much, Tharman. Very good morning to those who are in our time zone, or good afternoon, good evening. We just finished the annual meetings, and they are our first hybrid meetings in our history. They went extremely well, but we had to restrict attendance to the buildings to no more than 500 people at any one time, and respect fully pandemic control measures like testing, contact tracing, and social distancing, masks unless you speak. And this is very illustrative to where we are in the pandemic and the economic recovery from it. We do have some good news. As you know, we came up with our outlook. The recovery continues. But while in a small number of countries it is still gaining momentum, overall, in comparison to the first half of the year, we have lost a bit of momentum. And that translates into a slight downgrade of a growth forecast for this year from 6 to 5.9%. But this is not the whole story. What we are mostly concerned, and it came through the meetings, is that the recovery is uneven and it is uncertain. Uneven because of significant differences in vaccination rates across countries and significant and deepening differences in available policy space to support the recovery. Just as an illustration, low-income countries' projections for growth for this year is only 3%, and that translates into a divergence in economic fortunes that is not also deepening, but we are concerned it may become persistent. If advanced economies are to reach their pre-pandemic levels in the next quarters, or very close to them, or reaching them, for the economies that are falling behind, we are talking about 2024 or even later. Secondly, the economy is recovering in a way that unfortunately bears more uncertainties today than some months ago. And I want to talk about 2 of these areas of uncertainties. The first one is inflation. It was a topic that generated a great deal of discussion during the meetings, where the consensus is that we are still looking for more transitory inflation in advanced economies, likely to recede over the course of the next year. However, inflation in some emerging markets and developing economies is already pushing policymakers to take action. Interest rates in a number of countries have been adjusted upwards. And of course, the big concern we all have is that if this divergence is to persist, and we have the leading economies moving faster on the road of normalization of monetary policy, then we may be in a situation in which those that are not yet growing may get hit by tightening of financial conditions in a way that may cause quite a lot of trouble, both for public finances and also for corporates that are under a significant burden of debt, especially a dollar-denominated debt. And of course, we know that exchange rate movements could also be negative for a number of emerging market economies. The issue of inflation, however, was much more deeply discussed as we came to what is driving it. And there, the attention focused on two issues. One, movement of energy prices. We have seen that movement quite disturbingly going up. We all understand that at the heart of it are mismatches between demand and supply. And we understand that supply eventually will catch up. But the picture is actually more complicated than that. One of the reasons of mismatch between demand and supply is the increased impact of a changing climate. When the summer is very hot, if the winter is very cold, demand for energy goes up. And we have to be mindful that climate-related shocks, unfortunately, are on the increase, and we need to factor this in the way we think about supply of energy and energy mix. Most significantly, the conversation is moving into a much bigger topic, and it is the future of decarbonization. If we are to achieve the objectives of the Paris Agreement, we ought to take aggressive action during this decade. And if that means a recalibration of the energy mix, and it will mean recalibration of the energy mix, how this is being done, how we factor in the necessity of a carbon price and provide forward guidance to consumers and businesses in a way that does not risk to undermine public support for decarbonization is going to be absolutely essential. And I would take this little signal we now got from energy prices and how policymakers are responding to it, providing subsidies, how the public is responding to it. We heard in the discussions that in some countries there is a tax compensation if energy prices go up, and yet people are upset. Why? They see the price at the pump, but the tax relief they don't see at that same moment. So what is the right policy mix is going to be crucial. Another issue that took quite a lot of attention in this supply-demand mismatch was shipping and deliveries. What we now do in our economic forecasts, after adding epidemiological data, we are now adding shipping data. What we see is possibly this mismatch continuing well into mid next year, maybe even by the end of the year. And it is again a very interesting picture when you look under the surface of it. Most of the disruptions are caused not by shipping on sea, although there is a little bit of this. It is mostly caused by the fact that containers arrive and they're not drivers, so they cannot move to consumers. Why they are not drivers? Well, because the new pandemic economy has shifted massively the deliveries of everything from food to our daily purchases to drivers, and that labor market change that is happening, policymakers have to integrate it in their response. Just to give you one piece of good news, it looks like most of these supply delivery contracts are long-term, so the big guys are not going to touch a cost. In other words, increasing cost in shipping is not going to be a big driver. It is likely to be more the demand supply at the consumer end that is putting a bit of pressure. But it is a topic that of course is rightly so driving a lot of attention. We talked also about financial vulnerabilities and the fact that moving financial risk from the banking sector, where after the global financial crisis, people like Andrew and Governor Egang and all of the central bankers, they have taken strong measures. So the banking sector is sound. But when the risk moves to the non-banking and 50% of financing is there, then of course we see more risk, and we see a bit more risk from crypto assets for the new classes that are coming there. So what does that take us to? It takes us to also looking at debt with much more seriousness, both corporate debt and sovereign debt, and especially for countries that are already under high level of debt distress. And telegraphically, one of the issues that we wrestle with is how to make the common framework deliver. We have 3 countries that ask for it. We haven't closed any of those 3 discussions. If we are to have countries stepping forward, they need predictability of timing, and perhaps they need one more incentive, which is that stands still while they are in the common framework resolution. And we need to work on the more broadly on the debt architecture. We need to continue to work on collective action clauses, on contingent debt instruments, and more broadly on making sure private sector participates actively in debt restructuring. Finally, where did we land in policy recommendations? Very clear. And you would understand after listening to how we diagnose the status of the world economy. Vaccinate, number 1 economic policy, and if we do so, we would gain in the next 5 years $5.3 trillion. We want 40% at least of populations in all countries vaccinated by end of this year, 70% by mid next year. Second, calibrate. We are no more in a place when universal policy recommendations are sufficient because of this differentiated environment, different problems in countries, different policy space capacity. And that puts tremendous pressure on policymakers to have granular policy actions. And 3, accelerate. As Tarman said, we have to walk and chew gum at the same time. We have to deal with the immediate pressing priorities and the long-term transformation of our economies so they are low carbon, climate resilient, digital, and inclusive. For the fund conclusions, 1, we have to deepen our surveillance so we can support calibrated policies. And 2, we have to address this divergence. You know that we came up with $650 billion new SDR allocation to help everybody, but especially those in need. And Tarman co-chaired yesterday with Minister Gramegna of Luxembourg a discussion on how to amplify this allocation by getting countries in strong positions like the UK, Andrew, and actually like China to own lend parts of their new SDR allocation so we can amplify the impact of the allocation for countries in need give them resources for the exit from the pandemic crisis and the transformation of their economies. Thank you very much, Tarman.
Thanks very much, Christolino. That was an extremely clear exposition of the key challenges that we face. Thank you very much. We move now to Governor Yikang, please.
Okay. Thank you, Tarman. Hello, everybody. It gave me great pleasure to attend the 36th International Banking Seminar. The world economy is recovering, but with growing divergence. I totally agree Christolina's analysis. We confront some common challenges such as surging energy prices, supply chain bottleneck, and rising inflation. Meanwhile, we have to answer the question such as if the inflation is transitory, when and how to exit from QE policy, and how to deal with the macroeconomic policy spillovers. The COVID-19 front, despite of some sporadic cases, the pandemic is under good control in China. Close to 80% of Chinese population have been vaccinated, and the economy activity are now basically business as usual. But COVID-19 resurgence in the world, in countries, to create disruptions to the supply chain, and the supply bottleneck may well lead higher inflation and derail economic recoveries. Now, let me turn to China's economic outlook. China's GDP grew by double digit the first half of this year. We expect it to grow around 8% for the whole year. Due to flood and sporadic COVID-19 cases, the growth momentum has moderated somewhat. And that is the same as described as Christolina just now. The economic growth has been slowed down a little bit, but the trajectory of economic recovery remain unchanged. Producer price index increase is quite noticeable in China, whereas consumer price index growth has been very flat. In September, PPI and the CPI were up by 10.7% and less than 1% year on year, respectively. The rapid increase of producer price index can be largely explained by rising raw material prices, such as energy and metals. We expect PPI remain high for a few months before the upward pressure wanes at the end of this year. Consumer price index growth remain moderate, mainly because the falling of food prices, especially falling price of pork in China. The job market is stable. In August, the urban surveyed unemployment rate was 5.1%, the same as in July. Export and import are quite strong, and the current account surplus right now is about 1.5% of GDP. The effective renminbi exchange rate has appreciated by more than 5% since the beginning of this year. The Chinese economy is doing well in general, but we still face some challenges, namely mounting downward pressure on growth, rising macro leverage ratio, operation difficulties of small and medium-sized banks, and default risk for certain firms due to mismanagement and breakneck expansion. We are keeping close eye on all these problems so that they do not evolve to become systemic risks. We have maintained a prudent and accommodative monetary policy. The People's Bank of China cut reserve requirement ratio by 0.5 percentage point in July and recently added 300 billion renminbi special central bank lending to support small and micro firms. Fiscal policy is also trying to become more effective and sustainable. Direct fiscal expenditure to key areas such as supporting the unemployed people, social benefit is now secured at all levels. To fend off financial risks, the People's Bank of China is working on curbing rising macro leverage ratio, resolving the risk of a few financial institutions such as Baoshang banks, and replenish capital for small and medium-sized banks in particular. Apart from the above policy responses, we are also moving ahead on the following 2 points. First, green finance. We are working to promote China's green transition. We have revised the green bond endorsed project catalog and delete from it the fossil fuel projects. In line with suggestions made by the Task Force on Climate-related Financial Disclosure, we have released a guideline for financial institutions on disclosing environmental information. Monetary policy tools for reducing carbon emission are in the pipeline for the PBOC. We are also actively engaging international cooperation. By supporting international organizations' capacity building programs for developing countries, we are helping with the green transition in the developing world. Second, fintech. Fintech has made financial services more accessible, efficient, and inclusive. At the same time, we should not neglect its side effects, such as abuse of monopoly power and excessive collection and exploitation of clients' data. Therefore, while promoting healthy development of the fintech industry, we have also worked hard to level the playing field, improve financial inclusion, and protect of consumer privacy. Hopefully, such effort will improve anti-monopoly regulation and make our policies more transparent. The People's Bank of China stands ready to work more closely with international community on all those issues to jointly usher in a strong, sustainable, balanced, and inclusive recovery of the global economy. Thank you.
Thanks very much, Yikang. That was a very useful survey of the key issues. And I would say some of the issues which you've addressed are not unique to China. And China's role in addressing them will have very important international implications as well, both with regard to green finance and fintech. Thank you. We move now to Augustine Carstens. Augustine.
Well, greetings to everybody, and thank you very much, Tharman, for inviting me to be a lead speaker in this panel. The topic of the session, managing uncertainty, needless to say, is very timely. At the same time, it is a cliche when discussing a topic like this to say that the outlook is more than usually uncertain. Uncertainty is always with us, but its nature changes over time. For most of the past 18 months, there was one big source of uncertainty that was easy to identify, but whose impact was hard to predict, and that is obviously the COVID pandemic. The pandemic isn't over and its trajectory remains unclear, but the worst is hopefully behind us. We are now in a more normal situation. But this still means that there are many sources of uncertainty, some known and some unknown. Some will turn out to be inconsequential, others will matter greatly. We therefore face the more complicated task of both identifying the sources of uncertainty and working out which ones matter. Policymakers, of course, face the additional challenge of determining how to respond. When I look at the global economy, I see three key uncertainties. The first is whether the robust recovery of private demand, at least in advanced economies, in the aftermath of the recession will continue. The COVID recession was unique in many ways. It was a truly exogenous shock and to a large extent a policy-induced recession. Although the downturn was incredibly sudden and deep, the fiscal and monetary policy responses were extremely fast and extraordinarily strong. Partly as a result, private demand has bounced back much faster than after recent global recessions. Some forecasters expect the level of GDP in advanced economies to return to its pre-pandemic trend by the end of next year, a truly exceptional outcome by the standards of past recessions. But the continuation of these trends is not guaranteed. In many countries, businesses were already heavily indebted before the pandemic, and leverage has increased further. This could weigh on investment. Household income has held up, due in large part to extensive fiscal support, but this support cannot last forever. When it ends, personal income and consumption could take a hit. A material pullback in private demand is unlikely, but the jury is still out about the sustainability of demand in the absence of extensive policy support. The second uncertainty is about the persistence of changes in the composition of demand. It is well known that the recession saw a shift in the composition of demand from away from services towards goods. Lockdowns, as a reluctance to put oneself at risk of infection, curbed services demand. At the same time, people who spent a lot more of their work and free time at home found that they needed desks, chairs, computers, and televisions. Many of us assumed that as restrictions eased and vaccination progressed, consumption patterns would start to revert to something more normal. But that hasn't happened. To cite one example, according to the most recent national account data, household consumption of goods in the United States was 18% higher than it was immediately before the pandemic. Consumption of services remained more than 3% below. Incredibly, the gap between these two figures is wider now than it was in the middle of 2020. It is hard to believe the difference between goods and services consumption will not normalize again at some point. It is hard to say when that will be. The third uncertainty is how much adjustment will take place on the supply side of the economy. We hear a lot about supply constraints and bottlenecks for computer chips, commodities, and container ships these days. Talk of supply constraints immediately conjures the impression that production of these goods and services is much lower than it was before the pandemic. But the reality is more complex. One needs to look at both prices and quantities. There clearly has been a loss of supply in some areas. This is most evident where lockdowns continue to disrupt production. And in economies that have opened up, putting the supply side of the economy back together has proved difficult. High jobs vacancies at the same time as elevated unemployment rates are one example of this. But in time, most of these frictions should be resolved, restoring pre-pandemic supply patterns. Less production does not tell the whole story, however. In many cases, the cause of bottlenecks seems to be the suddenness of the recovery in demand, in conjunction with the changes in the composition that I mentioned before, bumping up against inelastic short-run supply. In these cases, if firms expect higher demand to persist, the solution to bottlenecks could lie in higher investment to expand supply capacity. But how much investment occurs and how quickly it will result in more production and resolution of bottlenecks remains highly uncertain. In light of these uncertainties, I will now briefly outline 3 scenarios of how could they play out. The first would occur if a combination of softer aggregate demand as policy stimulus is withdrawn, in conjunction with the normalization of consumption patterns, sees pressure on supply chain ease. In this scenario, we could find ourselves in a situation similar to before the pandemic, with inflation below central bank targets and economies struggling to maintain growth momentum in the absence of extensive policy support. The second scenario would occur if demand remains robust and concentrated in the goods sector, but supply does not respond. This would resemble a stagflationary scenario. Without more supply, rising demand may not add much to growth, but would instead translate into higher inflation. Central banks could face the kinds of tricky trade-offs between stabilizing inflation and maintaining growth and financial stability not seen for a generation. The third scenario would occur if the supply side does respond to strong demand conditions. This would clearly be a much better outcome, but it would also not be without risks. It will take time for capacity to expand. Until it does, higher levels of investment would put further pressure on already stretched supply conditions. In this environment, monetary policy normalization might be needed sooner than currently anticipated. This would be a good normalization, driven by a strong, sustainable recovery. It remains to be seen how resilient firms, households, and governments, particularly in emerging markets, would be in that kind of environment. I would like to conclude with a few words on what uncertainty means for policy setting. A natural temptation is to try to take more control and adopt more specific policy targets in order to eliminate the uncertainty. But we need to be very cautious about this course of action. We used policy intensively at the outset of the pandemic, among other factors, to reduce uncertainty in the short term. But in a way, uncertainty has been kicked forward, in particular when we realize that fiscal and monetary policy space is not infinite. Trying to fine-tune outcomes could lead to erratic policy making and lead to even larger required adjustments later. I'm not suggesting that policy needs to be wholly passive or rule-bound in the face of uncertainty. Rather, it would suggest that the existence of uncertainty should encourage a sense of humility about what is possible. Policymakers can't hope to smooth every single economic up and down, nor should they. Instead, they should focus on the really important things, achieving their long-run objectives while avoiding, or if they can't be avoided, responding appropriately to the really big economic potholes and accept a few bumps along the way. Lastly, more is dearly needed to understand much better supply-side dynamics. If I had to characterize the years ahead, I would say that it will be the period of the great reallocation of resources, both due to the evolution of the pandemic-induced recession and dislocation of markets, but also due to underlying trends that have been exacerbated in the recent months, for example, automation. This calls to front-load structural reforms that would give rise to both higher sustainable potential output and would render more flexible economies. Thank you.
Thanks very much, Augustine. That is a very thoughtful perspective. Thank you. And your posing of the implications of uncertainty more fundamentally for the way we think about what is possible in policy and how we balance those risks of very different scenarios over the medium term was very useful. Thank you. Over to Andrew Bailey now.
Well, thank you, Tom, and it's a real pleasure to be participating. And as you said, it's the next best thing to be participating this way than to be doing it in person. So we look forward to getting back to normal. I'm going to start with some thoughts on the current situation and then offer some further thoughts on some of the issues that we face. I mean, as others have said, the recovery of the world economy is slowing, and we see that also in the UK economy. Now, in one sense, as the impact of COVID reduces and the uncertainty around that impact does reduce, and we are seeing that reduction in economic impact, it's natural that as the catch-up moves towards its completion, then the rate of recovery will obviously slow down and decelerate. But of course, and we've already touched on this, that's not the whole story by any means. There are, as you said, Tom, at the beginning, two very big moving parts here, more so than I would say in typical recoveries. Both supply and demand are moving. And that's the challenge that we face. Because there's no question that growth is being affected by supply chain effects, which are acting as a drag. We see that for instance, in manufacturing and construction output. And meanwhile, as Augustine has just said quite rightly, the rebalancing from goods to services demand is taking longer. Now, maybe that's a reflection of continuing caution towards the impact of COVID. I think that's quite possible. But if you take these two things, you take the supply chain effects and you take this rebalancing, which is taking longer, then of course those two things are interacting. Stronger goods demand and supply chain disruptions are interacting. And that is clearly pushing up the price of traded goods worldwide. Now add into that another very substantial element of the story, which is the substantial increase in energy prices. This is the largest current impact on inflation. Since early August, wholesale gas prices are up by about 140%, and they're highly volatile. And oil prices are also up, though by less. Now, in the UK, we have also got some important issues on the labour market. I want to start with a piece of what I regard as very good news. The impact of COVID on unemployment and household incomes has been very benign relative to what we thought and feared. Likewise, very similar story to date on business failures. So in the broad sense, I think we need to remember, notwithstanding the challenges that we face today, that economic policy has, through the COVID crisis, worked as we intended it to work. And that's notwithstanding, of course, the challenges we face today. Certainly in the UK, labour demand has been stronger than expected, and that continues to be the case. The ratio of vacancies to unemployment is above its level before COVID. And there are, and I do have concerns about labour supply growth. Inactivity has risen. For us, that's concentrated in young and older workers. It's also concentrated in men, not women. And that question about the return into the labour force, more so, I think, for the older workers. I think the younger workers are staying in education temporarily, and that makes a lot of sense. But that is a very important question. Now, if I turn to inflation, we've already, of course, seen the rise in inflation, and I'm afraid the energy story in particular is going to push it higher. I continue to believe that higher inflation will be temporary because it's in the nature of the underlying causes. But the energy story particularly means that it will last longer, and it will, of course, get into the annual numbers for longer as a consequence of that. And that raises, of course, for central banks the fear and concern of embedded expectations. As I said before, monetary policy cannot solve supply side problems, but it will have to act and must do so if we see a risk, particularly to medium-term inflation and to medium-term inflation expectations. And that's why we at the Bank of England have signalled, and this is another such signal, that we will have to act. But of course, that action comes in our monetary policy meetings. So let me turn now to some issues. I should say that Tom and I saw each other in Washington last week when we were both in Washington. Tom said, "Can you raise some issues?" So I'm going to have a go, Tom, to rise to your challenge. Let me start with the COVID response around the world, and it picks up what Christolino was saying. The response has been, there have been, of course, variations in the response. It's an interesting fact for us that we begin every quarterly monetary policy forecast round these days with a meeting with the UK's chief medical officer. That's, I guess, a sign of the times. But one of the things that all our learning, and I should say it's learning because we're not medical experts, suggests is that COVID, we can't eradicate COVID. It's not that sort of disease. What we have to do is adopt measures and approaches that will allow it to, in a sense, be managed. We can deal with it. So it becomes more like some of the seasonal illnesses that we have every year. Now, what that means, of course, is the adoption of effective vaccines and treatments, primarily. And so the key point I want to make to underline what Christolino was saying is that there is an economic case for vaccination worldwide. I mean, no question, there's a moral case as well, but there is an economic case. And without it, we are seeing another contributory cause to the disruption of supply chains. That's my first point. My second point concerns what I would call safe openness in the world economy. We must not give up on free trade because we're seeing disruptions to supply chains and in energy markets. Equally, I would have to say that some of the things that I observe in terms of resilience in those supply chains concerns me. Now, we learned the hard way. I think in the financial area, financial services area, let's face it, we learned the hard way in the global financial crisis. We had our moment. And since then, as you were saying, Tarman, we've adopted, substantial regulatory reforms. We've adopted stress testing in the banking system. We've adopted resolution approaches. We've done a huge raft of things to address that. Now, I'm not saying, we have the magic answer to supply chains across the board, but I think there are lessons that we've learned in terms of resilience that can usefully be adapted and used and translated into some other markets, particularly, for instance, when I look at energy supply. The final thing I'm going to say, and in a sense it leads into the next panel, I know, is just a couple of thoughts on climate. I have to say to those who challenge why central banks are involved in this field, that the macroeconomic effects of climate are very real now. The supply issue we have in energy today may or may not be worse than things we've seen in the past, but the response in the past and in recent times, of course, has been to use more coal. It's been to use more things that create more carbon emissions. And it's going to happen, I suspect, again over this winter. So I would say to those who think central banks should ignore climate change that it's just not realistic. We're facing the issue today. And that leads me to a second point, which Christolino, I think, spoke very clearly on and very well on, which is there, of course, is no doubt, I think, that relative to the externality that it creates, carbon is underpriced today. We don't have adequate carbon markets. And the price would be higher if we did. And it would be, and it also, by the way, needs to be consistent, of course, to avoid otherwise creating another issue for free trade and open markets. But we're going to have to be very careful, as Christolino said, to make this adjustment and advocate it in a context of high energy prices, because it could easily provoke an adverse reaction for something that is important in terms of the macroeconomic outlook for the world economy going forwards beyond the immediate context. Again, another very important issue we face. I would observe that I think the macroeconomics of climate change has been relatively underdone to date as an argument that needs to come out and why it's important. So, Tom, I'll offer those thoughts. I hope that somewhat matched up to the challenge you posed me. And I'm very much looking forward now to the Q&A. Thank you.
Thanks very much, Andrew. Thanks, that was extremely useful. We have two questions already, and what I'm going to do is to read both of them out and then take them one at a time. The first is for Yikang. How is the People's Bank of China and the government gauging the potential need for the government to take steps to avoid systemic risk developing as Evergrand continues to melt down? Can you continue to depend on private corporations buying Evergrand's bonds to avoid taking more steps on the PBOC and government side? So that's Yikang's question. And I'll read the second one out as well, which speakers can come to after Yikang has responded. The second one is a broader question from Mohammed Al-Arian. Given the unusual combination of uncertainties and the complex realities that speakers have mentioned on the ground, how deep was the conviction at the annual meetings that inflation would be truly transitory. Already we are seeing behavioral changes among companies, labor, and government. So that's Mohammed's question, which any of our speakers could address. And I think it sort of touches on where we were coming from already. So we'll start with Ikram.
Yes, thank you. Thank for the question. The recent happening of Evergrand caused a little bit concern and a wide discussion. Evergrand is a real estate developer, and right now it have the problem. Probably it cannot pay the payment, and also suspension of construction project, and there are uncertainty to deliver the pre-sold apartment. Those kind of risk we are facing. I think overall we can contain the Evergrande risk. And first we try to prevent the contagion from Evergrande to other real estate companies. Second, we try to contain the risk for financial sector. Only 1/3 about Evergrande liability is to the financial industry. The total liability of Evergrande is about $300 billion US. So that in terms of the liability to financial institutions, it's spread on hundreds of financial institutions, so that there is not very much concentration. I think the principle we try to deal with this case is that the right and interest of creditors and shareholders will be fully respected in strictly accordance with the law. And also the law has clearly indicate the seniority of those liabilities. And also we try to protect consumers and the home buyers' right. So that I think in the overall consideration, we will treat this case in strictly according with law, and protecting the consumer's right, home buyer's right, pretty much at a higher priority, and treat all the creditors and related parties equally under the law. I think if we can contain the risk, not spreading, I think we can prevent systemic risk. Thank you.
Thanks, Yikong. Would one of our other speakers like to address Mohammed Al-Erian's question on transitory or non-transitory inflation, and what we're already seeing as behavioral adaptations amongst companies, labor, and governments? Christolino?
I suggest I start because part of Mohammed's question, very good question, was how did that feature at the annual meetings? And I would make 3 points. One, that it featured quite prominently. That was one of the issues that a great deal of attention was given to, recognizing that vis-a-vis the spring meetings, we are more vigilant about understanding uncertainties in the world economy and how that relates to both price dynamics and role of central banks. So we are in a somewhat more uncertain space now. And as you heard from the presentations we all made, that relates to the degree of unanimity and confidence we have on how exactly this particular trend is going to shape up. Secondly, there is that more granular understanding that inflation is already a different phenomenon in different countries. That stems out of this divergence I talked about. Already we have quite a number of emerging markets where it's a systemic rather than a transitory phenomenon. And just to be more illustrative on this point, we see fairly significant action taken in fairly large emerging market economies such as Russia or Mexico, and that tightening of interest rates, of monetary policy conditions, is on its own clear that in these places their policymakers are sufficiently concerned already to take action. And the third issue is, the third point is there still mostly a consensus that in advanced economies, Andrew actually said temporary, he didn't use the term transitory, that policymakers have the tools so they can use these tools. And in that sense, there is no significant concern that this would be a runaway train. We are very familiar with what these tools are and how they can be applied. And finally, Mohammed, a lot of the conversation is about inflation expectations possibly de-anchoring, and that attention to this is, I would say, higher than it was a couple of months ago. And I think Andrew can step in and certainly in a much more part of mandate, direct mandate manner, talk about it.
Well, I'm not sure.
Andrew,
yes.
Andrew, before you answer, I'm going to read out two more questions which are on the same theme so that we address them together. From Jerome Jean Hegli, monetary policy cannot solve supply-side problems, as Governor Bailey outlined. However, ever lower and negative policy rates make the supply-side repair also more difficult. Even as global growth momentum is slowing, are we not risking to be too late in the central bank tightening cycle, even if inflation pressure will prove to be transitory? A second sub-question, real estate markets. Any sense from the meetings that we should be more concerned about the overheating in many advanced economies in real estate? A question from Piercarlo Padoan, our colleague from Italy, former finance minister. What are, in your view, the risk of stagflation becoming more pronounced, also, given the lack of structural adjustment? So I thought we could take that together with Mohammed's observations. Andrew?
Oh, thanks, Simon. Well, I'll have a go. I mean, let me start by saying one of the questions that I get asked quite often is, well, does transitory in the context of inflation have a fixed time attached to it? And the answer is, I mean, no, it doesn't. It really has to, in a sense, be calibrated in terms of the underlying dynamics of the shocks that we're seeing and the adjustment out of them. But of course, there is this very difficult balancing act that we have to do between the fact that we can't tackle those underlying shocks with monetary policy. Some of them, I'm afraid, have shorter and longer natural durations, and the fact that we have to act in our world to underline the credibility of the regime we have, and of course to preserve the huge progress we've made in terms of the credibility of monetary policy regimes. I mean, that is absolutely critically important. And so that's why we have to look very carefully at labor market adjustments, at firm pricing behavior, and of course at inflation expectations. I would say in the UK at the moment, that certainly taking the labour market and earnings, we're seeing actually a very disparate pattern at the moment. The headline figure is actually quite heavily affected by statistical issues, but the underlying number is strong for where we are in the cycle. But we're seeing a very strong dispersion of earnings. I'm not particularly surprised about that, given what we're seeing, but I wouldn't at the moment translate that into a general pattern of labour market pressure. And of course, labour market institutions are very different. I mean, trade union power is very different to the things we've seen in the past. On the question of solving supply side problems, I mean, I think the issues there, of course, do come back to investment. They do come back to raising trend rates of growth, which we certainly need to do. And certainly we need to do that in the UK. And we certainly need to get past this period where, of course, investment has been very weak, not least because of the high level of uncertainty we've had. So I would distinguish that from monetary policy. By the way, also, I think that the story in investment does differ a lot between what I might call more digital forms of investment and more traditional sort of bricks and mortar forms of investment. The former has been stronger than the latter, and I'm not surprised at that. And I think, if anything, I would hope and expect we'll see more of that. Real estate, let me just say one thing on real estate. It's very interesting in the UK. We've seen a reversal of the pattern that we've had for the last 20 or 30 years, with a very heavy concentration of strong real estate prices around London and the southeast. Actually, we've had the complete reversal. London and southeast has had the weaker real estate market, and we're seeing much stronger prices elsewhere in the country. And the really interesting question there is, does that reflect a change, of course, a more structural change in the ways of working going forward? With people in a sense being prepared to sort of to work further from their base, if you like, but take advantage of the real estate market. And I think that would be, frankly, for the real estate market, that is not a bad thing at all. Now, let me say on stagflation. Now, if one of our central bank colleagues was here, he would denounce the use of the word at this point as a wholly terrible word that has crept into use. And I had to confess last week that I think it originated back in the 1960s with the British Chancellor of the Exchequer. It's not, frankly, a very good term, though. It has a very imprecise meaning, it seems to me. It's true, as I said in my remarks, that we're seeing a slowdown in growth and we are seeing higher inflation. But I think the term stagflation tends to take on rather, how shall I put it, rather exaggerated meaning. So I think it's better to stick to understanding the dynamics of it. Thanks.
Thanks, Andrew. Augustine?
Thank you very much. Well, I mean, my perception at the meetings was that there was a fair amount of consensus about the abundance of different issues that certainly can be affecting inflation or measured inflation in the short term without necessarily implying a change in the dynamic, in the medium and long-term dynamics of inflation. I mean, if I go back to my initial remarks, we are in a period where we have had major dislocations in the domestic economies and in the world economies. We sort of went all together in the same time to this recession, but we're going to go out at a different speed and with a lot of different issues facing across markets and across nations. In a way, I mean, if we think that this will need to have a huge reallocation of resources, to do the reallocation, we need price signals. Therefore, these relative price changes will help us the reallocation of resources, and down the road, it probably will be what will make us converge to a more normal state of affairs as soon as possible. Now, that doesn't mean, again, as Andrew and others said, that central banks would have to be just being absent in the whole issue. I mean, I think the key is to prevent a second round effects of affect inflationary expectations. But I think we need to make the case that these relative price changes are important, and we need to let them be there. What does tightening prematurely monetarily policy mean, or being too obsessed with some inflation targets? Well, it means that those sectors that are not being affected necessarily by structural or temporary issues, we would need to suppress. It would mean a lower economic activity, and it also would probably risk some financial stability issues. So I think that we need to be quite patient about it. I think if there is something that we need to remind ourselves is that in the last 30 years, the world economy has been very successful in keeping inflation under control, including emerging market economies. I mean, yes, Christolino is right in saying that in some emerging market economies, we have seen some inflationary pressures and that they have needed to act. And I think the way they have been acting is correct because their inflation expectations formation is more vulnerable. But also it represents something completely out-normal of what we have been experiencing in emerging markets in the past. I would say no. Therefore, I mean, I like to mention in this debate, now that we are all very, very attuned to medical issues, you know, I like to make the following simile. Aggregate demand is like bacteria. Aggregate demand problems are like bacteria fighting bacteria problems, and aggregate supply is like fighting viruses. If we try to fight a virus with medicine for a bacteria, we might end up worse off than when we are. And that's what I say, that oftentimes real sector issues, supply sector issues, if we insist in trying to solve them through very proactive aggregate demand policy, we might end up to be worse off. Diagnostic is very important. I think we have made progress in the diagnostics, and I think that we can be, I would say, more attuned to administer the medicine we need, given that we have a better diagnostic. Now that doesn't take away all uncertainty, but I think that we need to let things happen when we have some certainty, but that also explain why is it important that we let, for example, some inflation to be above targets in the short term.
Thanks, Augustine. There was a related question from George Seljan, which has been partly addressed, but I'll read it out in case anyone wants to chip in. He says, I understand that central banks cannot ignore the macroeconomic consequences of climate change and that carbon emissions are underpriced. But I wonder if you mean to suggest that central banks can somehow address what is essentially a relative price distortion, or whether you agree that that must be addressed by other means. Now, I think you just commented on that, but if I could respond to what has been said, we may not be facing only a relative price change over the medium term. If it was just a relative price change where the price of fossil fuel-based energies goes up and sends the right signals to the market, well, that's what we would have wanted to see. But we are unfortunately also facing a shortage of supply of renewable energies relative to demand. And that supply, particularly the pace of innovation in renewable energy storage, just hasn't kept pace with the demand that we are seeing and we are likely to see. So we may very well be in a scenario of rising prices for both dirty and clean energy for a period of time. That's one context. Now, bearing in mind what Augustine said earlier about the fact that, look, a few scenarios are possible, and we must have the humility to accept that we don't actually know which one will play out. What should be the respective roles of central banks and fiscal policy? Because central banking has always wanted to have an anticipatory orientation. You can't wait to see which scenario plays out, because then, as has been pointed out, you will end up having to make an even more major adjustment with greater disruption. So in thinking through with some humility, the fact that we don't actually know what will happen in this balance between growth and inflation over the medium term, what should be the respective roles of central banks and fiscal policy in dealing with that in advance and dealing with that as the situation plays out? Andrew?
Thanks, Tom. And I mean, you've answered the question excellently, brilliantly. Thank you. Let me just add a few thoughts. I mean, of course, it's true. I mean, I would be contradicting myself, if I didn't recognise that I said that monetary policy can't tackle supply side shocks. So central banks don't have the tools to in a sense, tackle these things. But you were absolutely right to make the point about anticipatory need. First of all. Secondly, you're absolutely right to make the point that we run the risk of having a shortfall in both renewables and traditional sources. And if I can borrow and sort of risk abusing a phrase, one of our roles is to sort of speak truth to shocks, as it were, to point out the shocks that we're seeing, even where the solutions to those shocks are not in our toolkit, as it were. I think central banks have to do that, because these shocks affect our world, as you rightly said. The last point I'd make is just to re-emphasize the point I made about resilience. I think, again, it's not our world, but I think we do have some things that we've learned in the last decade or more in our world, in the financial world, that could be useful in terms of thinking about the degree of emphasis we've put on stress testing, the degree of emphasis we've put on contingency planning. And while I don't want to boast that we're perfect, we're always learning lessons. We're always facing new shocks, which is why we've touched on non-bank financial institutions today. There may be some underlying some things that we've learned that could be useful in this debate, and if so, then we should obviously share our thinking. Thank you.
Thanks, Andrew. There were, by the way, a couple of other questions on related to climate change. And if we don't deal with them in this session, we'll be dealing with them in the next session. But I'm going to come to two other questions. One, which touches on resilience again, from Marcus Brunemeyer. And he asks if there's specific lessons that we can learn from financial resilience measures for global supply chains. In other words, the lessons that we've already learned from financial resilience, whether there are lessons from that for global supply chains. Should one require stress tests for global supply chains? Should one expand the strategic reserve holdings of certain commodities beyond oil? Also, would this help to better anchor inflation expectations as price swings can be smoothed out? So I think that's a very interesting question. A specific question came for Yikang from David Marsh. Can you say a few words about how the digital yuan could have an impact on the global importance of the currency, with particular reference to the development of the countries involved in the Belt and Road as a potential renminbi zone? Now, of course, that's a very broad topic, Yikang. So if you could give us a very quick insight of your thinking on it. So do you want to start, Yikang, with that question, and then we'll come to the others on the broader question?
Yes. Thanks, David Marsh, for your question. I think our CBDC, right now we call it eCNY. Right now, our focus is on domestic and retail use of the eCNY. I think cross-border use and also international use is a little bit complicated. Legal questions such as anti-money laundering and also know your customer requirement. And also there is a very deep discussion among the central banks in the international community. So that given the complication of cross-border use of CBDC, I think right now our focus is the domestic and the retail use, and see how it comes. But I will keep in mind that we will closely cooperate with central bank community, BIS, IMF on this issue. In terms of the use on the Belt and Road, I think that is not our priority at this point. Thank you.
Thanks, Yikong. Would anyone like to comment on Marcus Brunnemeyer's question? Yes, Christolino.
Great question. And actually, I saw a couple of other questions connected to that same topic. Let me start from the fact, it is nothing that we can argue anymore about, that we are in a more shock-prone world, primarily because of climate shocks, but also because of our interconnectivity. Other types of shocks, like the pandemic, we have to anticipate they will be coming in the future. Therefore, the concept of resilience is becoming central for everyone, for policymakers, for private sector, and also for us as individuals. What does that mean? More broadly, it means that we have to work towards a comprehensive approach to answering that call. Resilient people that are educated, healthy, that they have a vibrant social protection, so when a shock comes, they can adjust and respond and also connect to others. Resilient planet, that is so very clear, we have to work aggressively towards it. Resilient economies in which supply chains also have to be more resilient. What it translates into is we virtually need all hands on deck. Let me start from central banks, since we talked about them. Central banks have a very important role to play by bringing standardized disclosure of climate-related risks and other risks in a way that is compatible across the world, and they're already doing it. The network for greening the financial system is already doing a lot in that regard. And also introducing stress tests for climate-related financial stability risks, and we at the fund are partnering with others on that topic. Secondly, we need policymakers to step forward and look at all these potential risks and then how these risks can be better understood. By the way, I agree with the word humility. Understood, and constantly that understanding needs to improve. Policymakers have a huge role to create an incentive for shift to the low carbon, climate resilient economy. In terms of low carbon, we know what the incentive is. It is called price on carbon emissions. The best way to introduce this price is through tax, the most efficient way. By interesting snippet of great news, Uruguay just introduced $120 a ton carbon tax. But carbon trade also can play a role, and even regulatory equivalency to carbon price can play a role. And we need to put this trajectory of carbon price going up. Today, average carbon price is $3 a ton globally. It has to get to $75 a ton by 2030. And that forward guidance is absolutely necessary. Otherwise, we cannot reach the Paris Agreement. And the private sector has a huge role to play by deepening the carbon markets. They're the only people that can do it. By introducing, and many are doing it already, shadow price on carbon, so they shape up their production costs given what needs to be done. And by innovating, it is the private sector that is going to bring the technological solutions. Of course, I also want to see R&D in climate, public R&D going up. So let's stop here, Tarman.
Thanks, Augustine, and then Andrew. You'll have to be both quite succinct.
Yes, very quickly. With respect to Marcus's question, I think there is a very big incentive for the private sector who do most of the trading and do most of the economic activity to figure out some different aspects of what the bottlenecks and the distortions have been. Of course, they are observing, and they are suffering major shocks. Some strategies that were present in the past probably are not necessarily optimal now, like just-in-time production and so on. So I think we first should rely a lot on what the private sector has to do. Now, what we in the public sector need to do is also have a clear diagnostics and see if we are introducing some major distortions there. I think one that was mentioned by Andrew is that we need to, for example, to keep very clear our commitment to open trade and to have clear rules about rules of engagement in that respect. And we also have to evaluate, for example, what different global broad initiatives can imply in the very short term. For example, all these this very strong movement towards addressing climate change might have made transition more complicated in terms of assuring energy sufficiency at the right time, you know. So I think that we need to be much better. I mean, that doesn't mean that we should disregard or not mind climate change. That's not what I'm saying. But as a matter of fact, to make that attempts to be sustainable over the long term, we need to avoid transitory dislocations in markets. And for that, probably we need to figure out much better the transition paths. So I'll stop there.
Yeah, no, excellent point. Thanks, Augustine. Andrew?
Very briefly, I was going to recall a story from 2009 or 10 when we started introducing stress tests for banks. And I remember with our first scenario, somebody very senior in one of the banks said to me, but you don't really believe that house prices will fall by 40%. And I said, that's the wrong question. The question is, could they? And the answer is yes. And when I said today, you know, when we're in the Monetary Policy Committee, we're talking about what we think will happen and then putting risks around it. And when we're in the Financial Stability Committee, we're thinking about what could happen, often in the tail of the distribution. And that's a big change in mindset. And I think what I would recommend for these other areas, I'm not saying we have magic solutions, but I think it's this change of mindset to understanding both what you think will happen and what could happen.
Yeah, very well put. Thanks, Andrew. I'm going to take one question from Yolanda Morales from Mexico. And before I do that, I'll say that I'm going to port over to our next session the questions that were on climate change from Bill Winters, who talked about the very important issue of transparent carbon price, from Francis Malige, as well as Lyric Hale. We'll take up those issues in the next session, where we'll be getting into climate change more fully. But I want to take the question from Yolanda Morales, again on transitory pleasure and inflation. And she's talking about Mexico, where core inflation has been rising for 10 consecutive months. Is this an enough time to act more aggressively along the normalization road? Augustine, not because of your precedents, but just your perspective of the emerging economies more broadly. Do you want to comment very briefly on that? We've got just 2 minutes, and then we'll end the session.
Well, being an ex-governor, I don't think it's too kind for me to respond what is going on in Mexico. I mean, the more I can say right now is I think that the way the Banco de Mexico has addressed the issue, I think is correct, and there is plenty of explanations in their excellent inflation reports and communiques. So I would refer Yolanda to read the material in the Banco de Mexico. I think there's very good guidance there. Thank you.
Right, good, very, very good answer, Augustine. And I think we will end the session there. David Vergara's question has also been addressed. on whether there's a risk of monetary policies reacting too soon in response to what appears to be relative price shocks. I think it's been a good discussion with enough humility all around, and the points which were made about how we've got to build uncertainty into our thinking as distinct from projections and forecasts is a fundamental one, and with implications in particular for monetary policy. So thanks very much to our four panelists for your candid answers, apart from your opening presentations, and look forward to having you with us again. Thank you very much. And we are going to move now on to the second panel. We'll let our panel speakers, second panel speakers, come on. Thanks very much to all four of you. Thanks. Okay, well, let's move on to our second panel now. It's on the very important theme of the global commons, in particular financing the global commons, particularly with respect to assuring climate and pandemic security. The two are related. We know that climate and pandemic security are related. The science is never deterministic, but it's clear enough. The extreme weather events are happening, and the viruses and pathogens are coming, and the two are interrelated. We do not currently have a global architecture, an organizational and financing architecture to address this dual challenge, and this very fundamental challenge for both advanced and developing countries. It is, quite frankly, the primary challenge of our times. And whilst in the days when the World Bank was founded, the problems of countries having to reconstruct themselves and sort out country-specific problems, in the days when the IMF was founded and needed to help countries with balance of payments problems, that whole country orientation now has to be revisited in a world where the global commons are the central challenge which countries themselves are going to face, including the developing world. So they're quite fundamental issues we have to address. They are of a large scale. They have a complexity that we haven't had to address in previous discussions in international finance. And we have four exceptionally well-qualified, very well-positioned speakers to talk to us about it. We've got Minister Nirmala Sitharaman, Minister of Finance and Corporate Affairs of India. Thanks very much for joining us. We've got Mark Carney. Everyone knows Mark in his various incarnations, but he's here in his capacity as Special Envoy on Climate Action and Finance for the United Nations and UK Prime Minister's Financial Advisor for COP26. We've got Lord Nicholas Stern, Chair of the Grantham Research Institute on Climate Change and the Environment at the LSE. And we've got Lawrence Summers, former Treasury Secretary and currently Charles Eliot University Professor at Harvard. We will have the speakers in that order. And we start with Minister Sitharaman. Nirmala, over to you.
Thank you, Chairman Shanmugaratnam, distinguished panelists. Good morning to some and good afternoon to the others, and good evening also to those others who are in different climate zones. I congratulate the G20 leadership for organizing this virtual seminar. It's indeed a matter of great pleasure to e-meet you all, and I'm happy to know that the group takes this kind of an initiative every year to host international banking seminar, and it deliberates on the most pressing issues confronting the global economy and also the financial systems. I think the future of humanity depends on two things, both of which relate to health. And I'll probably highlight it saying health of people and health of the planet. And therefore requires very urgent, unconventional, and out-of-the-box real-time solutions. So I think today, and I hope this discussion today, we'll be able to advance our understanding of these issues and also seek to have some solutions on all of them. Technological and financial resources to deal with such current global crisis, both of health of humans and also the health of the planet itself, pose very serious challenges. But the challenge I would think, which will have to have a greater attention from our side, are that which focuses on the mobilization of resources and equally on equitable access to these resources. And even as we talk of these two focus areas, I would think it should be inclusive in that it brings all the geographical terrain across with a particular emphasis on vulnerable sections of the population. So Tharman, while talking about the introduction to this particular panel of discussion, said that there's no global architecture at the moment which can deal with this, and I fully agree. There is therefore a need to assess the efficacy with which the existing financial structures work towards strengthening them. We need to work towards strengthening them and also assess the efficacy of existing systems. They may or may not be an architecture which can understand both the issues in its full seriousness, but it is our business now to urgently deal with the need to have such an architecture. And in this, I think the MDBs, the international financial institutions, and WHO will have to play a very critical role. They need reform themselves. And if they need reform, I think the aspects on which the reform should result in good outcomes is financing of any of these two activities or both, that is the global health and the human health, in bringing transparency, and also more importantly, and I'll underline this point, that the involvement of all the member states in the decision-making process is what is needed. And if we do that, we must also understand and agree that the challenges will have to be shared, recognize that they have to be shared challenges, and if they're shared challenges, the solution and the ways in which we can come out of it will also have to be shared. So timely and equitable delivery of vaccines for all is one very important consideration, and that must be in the heart of all our collective efforts to enable recovery from the pandemic and secure ourselves from future such challenges. We are all very conscious of the preparedness and the response that we'll have to come up with. For a brief minute, I would say how India has executed with a certain adaptive and decisive responsiveness those very well calibrated announcements that we came up with in a phased manner have helped us to give the necessary support for our economy to come out of the challenges. Testing, I'll just give you two very important simple examples. testing was ramped up from 2,500 to nearly 3 million per day, even during the early phases of this pandemic. PPE kits were never produced in India, except here and there, one or two. They were negligible. Now we are the world's second largest producer of PPE kits. We have also increased our ICU beds. India, as it is turning to be a medical hub, but also for what we call medical tourism, which means that we have the soft power and also the infrastructure for attending to cost-effective ways of giving treatment for patients from across the globe. But we have increased our ICU beds and their capacities, ramped up production of oxygen 10 times over what exists, and equally, very quickly, skilled manpower was at the site where they were required. We had this now very well-known scheme called Ayushman Bharat, which is a digital mission where people are brought into a paperless, cashless, and no specific requirements for them to have paper-based documents on their medical records or anything. So completely digitized ways in which healthcare was being extended to all the people. Literally, the poor benefited from it, and we are glad that showed how inclusive ideas came through technology being adapted. Now, the latest number in terms of the people who have been given vaccination is about 977 million. And hopefully within a week, we should be touching the 1 billion critical mark. All this is happening because there's simultaneously upgrading of systems more towards bringing greater technology. So in the reason why I would want to place the Indian experience before you is globally, there is a need to have this kind of digital expansion into countries and their healthcare systems. Unless we do that, the benefit of technology, which is very quick in overcoming difficulties and reaching the vulnerable societies, cannot be achieved by many other societies, many other countries. We have, and I would say here in this August gathering, since we seem to come from similar democratic backgrounds, we have a special responsibility of democratic and transparent societies to prevent future pandemics. And I lay strong emphasis on keeping open supply chains for vaccine raw materials and components to help enhance vaccine production. We are also pursuing our efforts in the WTO for the implementation of the TRIPS waiver, which is a long drawn discussion issue, but very required in relation to prevention, containment, or treatment of COVID-19. So even as we're talking about the pandemic, the health of the planet is another big concern, where all of us are simultaneously grappling with so many different challenges in order to address our nationally determined commitments. So, and climate change, I'm sure all of you all would agree, and related trends have a direct and indirect bearing on the economy and the financial systems, including banks. So the road to combat climate change is through climate justice and provision of fair developmental space and inclusive innovations. These are absolutely critical for particularly the emerging economies, because I find many of the resilient solutions which can come up in such as infrastructure building, technologies for clean energy, and R&D, which are specifically driven towards climate, are all going to happen simultaneously. And new financial instruments may be necessary to channelize savings towards green initiatives and to make them more sustainable and rewarding. In this context, it may not be inappropriate for me to raise this issue that there's the concern about financing all this. It's good to know that there is increased realization in international community about delivering on the $100 billion per year commitment which is a finance being critical area. It's a commitment which is of crucial importance. But any further delay in fulfillment of these promises would mean further delayed transitions. So before I conclude, let me emphasize how important discussions of this nature, particularly with the best of minds in the world, must continue to work towards strengthening the capacity of all our nations for an effective and rapid response to pandemics, including through sharing of experiences, learnings and innovations, and ensuring efficient mobilization of resources so that all can be benefiting from it. So while doing so, we must also incentivize the relevant stakeholders and to align the global financial architecture with our climate and health ambitions and sustainable development goals. But the national circumstances will have to be kept in mind, even as all of us prescribe solutions. So I'm hopeful that all of us will rise to the occasion and give us adequate comfort that both the health of humans and health of planet are equally being attended to. Thank you very much.
Thanks very much, Nirmala. Thanks for that perspective, as well as for your leadership through this crisis. Thank you very much. I now turn to Mark.
Thank you very much, Tharman. Thank you, Minister, for your comments. I'll try to address some of the points that you raised in that. Just at the outset, with the theme of global commons, make a parallel between, obviously lessons of the COVID crisis is exposed the tragedy of ignoring systemic risks, of undervaluing resilience, a theme this morning, and of not investing up front. And this is, of course, ever more the case with climate change, a crisis from which no one will be able to self-isolate. I want to commend your high-level panel report to the G20, yours, Tharman, with Larry and others, which documents and puts in context the modest investments, but the essential changes to international cooperation that are necessary to limit the systemic risks from future health emergencies. Now, turning to climate, limiting the temperature increases to 1.5 degrees will require unprecedented investment, not modest investment, ambitious country policies, and a full-scale transformation of the financial sector. Let's be absolutely clear. This isn't about green this, green that. We will not get to net zero in a niche. We need fundamental change in order to finance this aspect of the global commons. Now, let me start with some positive news, which is that momentum is building. Since the UK and Italy assumed the COP presidency at the start of 2020, the percentage of global emissions covered by country net zero targets has risen from less than 1/3 to more than 3/4. Of course, these commitments must now be matched by effective climate policies, or NDCs, worthy of the task. And as Secretary Yellen and I and others in the G30 documented last year in a report, the more credible and predictable climate policies are, the more investors will pour money in anticipation, creating the virtuous circle of large-scale investment, faster decarbonization, more jobs, and faster growth. And of course, Christolino referenced this with respect to a carbon price and forward guidance in the earlier panel. Now, to encourage the closing of the gap between commitments and policies, private sector, financial sector is transforming, and the money for ambitious climate action is coming into place. Net zero commitments are now the organizing principle that's cascading down from the country level to the company level. Thousands of the world's largest businesses are now setting net zero objectives and developing their decarbonization plans. In my view, within a few years, this will be the norm in the advanced world. And again, I'll reference earlier panel, Augustine's underscoring the importance of clarity in the transition. This will help. More needs to be done. Now, in order to finance these plans, we need to change the plumbing of the financial sector and the commitment of its major players. So let me start on the plumbing. Our objective for COP26 is to create a private financial system in which every financial decision takes climate change into account. Now, it won't always be decisive, but the information, the tools, and the markets will be there at the heart of finance. And we have 24 major deliverables for COP26 in this regard. I'm not going to go through them all. We're on track to achieve them all. I'll just highlight a few of the most fundamental. Of course, it starts with climate reporting. 6 years ago at Paris, TCFD was a concept. 3 years ago in Hamburg, the final recommendations were delivered to G20 leaders. Now thousands of companies report on its basis, and virtually the entire financial sector demands TCFD disclosure. I'd argue the private sector has taken this disclosure about as far as it can on its own. And now it's time to finish the job by making these disclosures mandatory. Very much welcome Yigang's comments on TCFD and Chinese financial institutions in the earlier panel. I'd also note that in the past few months, the G7 is committed to mandatory disclosure, and critically, the G20 has signaled its broad support for the IFRS Foundation's proposed International Sustainability Standards Board. This proposes to produce a climate disclosure standard based on the TCFD by the middle of next year, which all of us involved in regulatory initiatives know that's lightning speed. It's because it's bringing in all of the principles into this process. Once in place, this will ensure capital allocators, investors, banks in over 130 countries have access to the comprehensive data that they need. Better disclosure and a heightened sense of urgency are leading to big changes in climate risk management. This is fiendishly complicated, but authorities are stepping up. There's now 90 central banks in the NGFS from countries responsible for more than 80% of the world's emissions and all of our globally systemic financial institutions. Central banks in countries with 50% of global emissions are now pursuing stress tests, and the IMF is making the assessment of climate risks integral to its regular Article 4 country reviews. Now, this plumbing, these basics around reporting and risk, will help investors identify the opportunities in the transition to net zero. Because given that climate change is an existential risk, it follows that those companies that are part of the solution will create enormous value. Now, in parallel with this, recognizing the social imperative of the net zero transition and that commercial opportunity, the best in finance are committing to managing the transition. When we assumed the COP presidency 18 months ago, $5 trillion of private financial assets were committed to net zero. Today, there are more than 300 major banks, insurers, asset managers, and asset owners from across 40 countries that control assets of over $90 trillion that have joined the Glasgow Financial Alliance for Net Zero, or GFANZ. GFANZ is the gold standard for climate commitments. Pledges are in line with the climate science and anchored in the UN's Race to Zero. Firms go well beyond committing to achieve net zero by 2050 at the latest for their financed emissions, in other words, the scope 1, 2, and 3 emissions of their clients. But they also commit to a fair share of 50% emissions reductions by 2030. In addition, banks are required to set out 5-year granular decarbonization plans, and all must report annually. We've broadened the membership of GFANZ in the run-up to COP and now cover the entire waterfront of financial services, so including insurance underwriters and the major market infrastructure firms such as credit rating agencies, stock exchanges, index providers, and major audit firms. Now, the real purpose of GFANZ is climate action, and that includes defining and requiring best practice net zero transition plans for companies and for financial institutions themselves. It means robust assessments of the degree to which the portfolios of financial institutions are aligned with net zero pathways. It requires developing new approaches to wind down or defease stranded assets transparently and consistently with the net zero transition. My last point, and crucial one for the global comments, is it means mobilizing capital at very large scale to finance the transitions in emerging and developing economies. And it goes to the heart of what Christolino was addressing earlier about ensuring that this is not an uneven medium-term expansion. Now, there's various estimates of what's needed, but somewhere on the order of magnitude of $3.5 to $5 trillion of annual energy infrastructure investment is required over the course of the next 3 decades. But 3/4 of that needs to take place in emerging and developing economies, including transition financing needs that rise to an additional $1 trillion every year by the latter half of this decade. So we heard earlier about the critical point of the 100 billion from advanced economy governments to the emerging and developing world, this is the 1 trillion need that rises above that. So to bridge that gap, we need to make, I'd argue, radical changes in the international financial architecture. Specifically, we need new country platforms which deploy blended finance at scale with high private sector multiples and which connect standalone private finance with projects that are consistent with high ambition country NDCs, including the element of winding down stranded assets such as coal assets in those NDCs. So there's big momentum in the private sector, not just on the scale of commitments, but also through pilots such as the recently announced CFLI in India. And this must be matched by the MDBs, who should focus on bearing risks that the private sector cannot, rather than crowding it out. That means specifically dramatically scaling up those blended finance vehicles and instruments and facilities that work. It means developing new first loss structures that reduce macro risks, such as FX or pool, across multiple recipient countries. And it means wholesaling bankable projects by preparing, originating, and then on-selling them to institutional investors to preserve balance sheet capacity. An important point is that MDBs could also validate projects that are consistent with Paris-aligned country NDCs, again, including those that wind down stranded assets. And this would meet the major new demands of financial institutions for net zero aligned assets resulting from their GFANZ commitments, remembering that those commitments total over $90 trillion. As a final point, let me underscore the critical work that Bill Winters, who's on this call, has led with Annette Nazareth. Over 400 organizations have helped to develop a blueprint for a new market for carbon offsets. The present market is small, it's fragmented, it's ineffective, subject to issues of greenwashing, but a high integrity global market is in prospect. Overwhelmingly, the flows would go to emerging and developing economies. The governance structure is in place. 40% of the members of that governance structure are from emerging economies. The major hubs, including Singapore and London, are setting up to anchor this market. This is a market that's $1 billion a year at present because it has all these challenges. But with the new structure ready to be up and running by next year, could rise quickly to over 100 billion per year, with over 90% of those flows going to the emerging and developing world. And it's a critical complement to absolute emissions reduction because we just don't have that much time. Speaking of not having much time, I have no more. Let me hand back to you, Tharman, and I look forward to the comments of Nick and Larry. Thanks.
Thanks very much, Mark. And we are all in debt to you for your leadership on this whole set of issues. Thank you very much. Over to you, Larry.
Thank you very much, Tharman. It's an enormous privilege to judge this, to participate in this forum and seminar. Once again, Tharman intends to, often puts me on these panels in the desire that I will be provocative, and I will attempt to follow through on that. Let me just say that I was privileged to host Nirmala at Harvard, and Harvard community is still buzzing about her visit, and that I cannot remotely approach Mark's degree of institutional erudition in discussing these matters. Let me first say that I think we should pause for a moment over something Nirmala said when she was at Harvard. She remarked that 1 billion people in India will have been vaccinated at the end of this month. We all rail about how the international community is not coming together, how these problems are immensely hard, how there's a lack of vision with respect to global public goods and all of that. It is a staggering achievement that 1 billion people in India have been vaccinated 3 months, 6 months after the United States started having a significant number of people. I know about how Africa lags. I know about many of the problems, but lest one think that the global community is incapable of doing things, if one steps back from it, a remarkable achievement is worth noting. Let me note, however, on the other side, two things that I saw this week. One is it is now fairly clear that President Biden's clean electricity plan, which was the centerpiece of the effort in the United States around climate change, will not pass as part of the Build Back Better legislation. And I would say the prospect of substantial political action beyond it prior to 2024 is minimal. The other is that I read this morning that the relevant planning minister in China, in light of energy shortages, has called for a massive step up and mobilization of China's coal-fired capacities. So while the world can act on these things, the world doesn't always act on these things. And there is both good news and there is bad news. I believe that we are not in place, but are within range of being in place to have the world in a much better place with respect to pandemics than it has been historically. And it will be, in a sense, just in time. My reading of the reinsurance data is that the prospects of a worse than COVID pandemic arriving within the next 20 years are almost surely greater than 50-50, that it could be substantially worse than COVID. My read is that given the divisiveness that now exists surrounding the origins of COVID, the international health diplomacy that causes these messages to be communicated immediately and action to be taken when a new strain is identified are right now in worse order than they were prior to COVID. And my read is that the highest return investment available in the world today in internal rate of return senses is the capacity to respond to a major pandemic aggressively. The outlay of an incremental $75 billion over the next 5 years would be transformative with respect to the risks of future pandemics. A future pandemic has an expected cost of perhaps $20 trillion. If that cost has a 50% chance of materializing, that is a $10 trillion cost. If the $75 billion expenditure reduces that cost by only 1/3, that is a $3.5 trillion gain over on a $75 billion outlay. That is approximately 120 to 1. The mean lag to that 120 to 1 gain is 10 years. But if you invest $1 today and you get $100 back 10 years from now, that beats any other investment that is open to anyone in the public or the private sector in the next period ahead. How the world cannot be coming together to make it is a mystery to me. It should be a central focus of the next meeting. I would make two other comments. As Christolino, I salute you. I salute your colleagues. I salute all of those who have worked hard on the SDR increase. I applaud all efforts to support the reallocation of SDRs. It is a valuable step forward. Let us speak frankly, though. SDRs are an instrument that was invented for a very different kind of problem than the problem that we face today. SDRs are an awkward tool for the problem of global goods, global public goods. Necessity is the mother of invention, and you have invented effectively and strongly with the tools that were available to you. But the world needs to take different approaches if we are on an enduring basis going to have an international financial architecture that meets the challenges of the period ahead. I would make these suggestions. First, the IMF, the world's leaders should call on the IMF to create a new modern systemic transformation facility based on the low conditionality, low stigma, long-term facility that was put in place to support the reforming economies after the Berlin Wall fell as a model. To support its creditworthiness, the appreciation in the value of IMF gold should be made available as backing, and it should be used as a basis for IMF lending on a substantially enlarged scale to low and medium term countries. This is an idea that would go far beyond existing proposals in not relying on SDRs as backing and in not requiring other IMF lending as a prerequisite. Under current provision, the lending could last 10 years. It would not be extraordinarily difficult to write language that provided for a presumptive renewal after a second 10 years so as to make 20-year financing available. Second, the World Bank should signal that it is in a new world by changing its name to the International Bank for Reconstruction and Sustainable Development. Third, in that context, the agreement reached under the Trump administration that the last capital increase of the World Bank would be its last capital increase, should be revoked, and negotiations should begin immediately on a very substantial capital increase coupled with a very substantial reformulation of traditional notions about its lending capacity for the World Bank and the other major development banks. Fourth, the resources of MEGA, the IFC, and the World Bank's Guarantee Authority should be, to make up a new word, de-siloed and combined into a single tool to support sustainable lending projects. The goal should be a tripling over 5 years of the level of World Bank support for developing countries. Such an effort to rethink, replenish, and ultimately renew the World Bank should be at the center of a global effort to address the challenges of climate change and global health. It is something that will not place substantial burdens on bilateral contribution. It is something that can be substantially catalytic with respect to a large amount of private finance. And it is time that we move past traditional dogma at the international financial institutions. I would dare to suggest that the details of a program of the kind I have outlined, their role, the complementary role that can be played by the world's very substantial volume of sovereign wealth fund resources, including the reserves of the world's largest reserve holder, are a fit subject for productive diplomacy at a vexed time between the world's two greatest powers, the world's two wealthiest nations, the world's two potentially greatest sources of cataclysmic threat, and the two nations that in so many ways hold the fate of the world in their hands. I am very fond, and on this note I will conclude, of telling the story of Ronald Reagan's meeting with Mikhail Gorbachev, where they went for a walk, and President Reagan, who didn't always read the talking points his staff wrote for him and was rather attached to science fiction, said to Mikhail Gorbachev, "Tell me something. If we were attacked by Martians, would you come to our aid?" And Gorbachev, as the story goes, looked somewhat nonplussed and then laughed and said, "Of course," and asked Reagan whether he would come to the Soviet Union's aid in such a scenario. And Reagan laughed and said yes. And they went on from that moment to contemplate the elimination of nuclear weapons. We do not face a gravest threat from Martians, but we do face a threat more grave than that from weapons, from viruses and what we are all doing to our common atmosphere. Collaboration on international financial institutions to help us move past that can be an important part of the way in which the world moves forward. I hope future historians will look back on this as being a period when it all began. Thank you.
Thanks, Larry. Thanks very much, including your concluding point on US and China. Thank you very much. No one more than Nick Stern has redefined the international discussion on climate change in a way that has injected urgency and clarity in the last 15 years. And Nick's leadership continues to remain a powerful force in current day discussions. So we're very happy to have Nick with us. Over to you, Nick.
Thank you very much, Tarman, and it's a real pleasure to be on the same panel as Nirmala, Mark, and Larry. And let me say at the outset that much of what I have to say is about the economics and the economics of policy that underlines the suggestions that Nirmala and Mark and Larry have put on the table. And let me say very strongly that I wholeheartedly support the four strand program that Larry has just set out. This is the kind of scale that we need. This is the kind of urgency that we face. I'm going to speak mostly about climate, but let me say something at the beginning on the pandemic. Tarman, you rightly emphasized that a disrupted climate disrupts the relationship between human, domestic, and wild animals and makes pandemics through the development and exchange of new viruses much more likely. Indeed, as you remember very well, Tarman, these two issues of climate and pandemics were central to the work we did together on the G20 so-called Eminent Persons Group, published 2018. Whilst I'm going to dwell on climate, I wanted to say that Larry's arguments about the rates of return to investing strongly in managing pandemics must be right. The resource requirements for serious tackling of that issue are really very small in relation to the magnitude of the problem. And I think I share with him the enormous admiration for what India has done. Other parts of the developing world have had to move, or did in fact move much more slowly, and the failure of the rich world to come and step up on this challenge has, I think, damaged internationalism, and we have to correct that as soon as possible. But let me turn to climate. It's holding to 1.5 degrees is, from the science, a very important target. 2 degrees is much more dangerous, as the IPCC has chosen. To stabilize temperatures, you have to stabilize concentrations. To stabilize concentrations, you have to go to net zero. To go to net zero in time to get to hold to 1.5 means going to net zero by mid-century. And of course, it's the cumulative emissions that count. So we must follow a concave path. We must bring them down quickly, not sort of plateau them for a while and then crash down later. That doesn't deliver what we need to do. So what's involved here? Well, it's a fundamental change in the way we do things, and that will need strongly increased investment and a changing in the composition of investment. Both Mark and Larry rightly emphasize that very strongly. So the question of finance of this side, this aspect of the commons, is actually a question of financing this investment and financing sustainable development. So our policy issues are understanding, incentivizing, delivering, and financing a new form of growth, and development, including, of course, strong innovation. What sorts of policies? Well, we face multiple market failures of direct relevance. Top of the list, the greenhouse gas externality. And there we do need pricing and various aspects of controls and standards and regulation. But given the uncertainty, given the increasing returns to scale, not just carbon pricing, but carbon pricing at center stage. But there are 5 other market failures, not marginal, central: research and development, capital markets, networks, information, and co-benefits, including the enormous costs associated with air pollution and other forms of pollution. And remember, it's not just market failure, it's absent markets too. We can't buy the technologies we're likely to need 25 years from now because we don't know what they are. Those markets are not there. And we surely know, whether we follow Schumpeter or von Hayek or Keynes, that in these kinds of contexts of market failures and absent markets, expectations and clarity of strategy are absolutely fundamental to realizing the scale and nature of the private investment we need. So we recognize that climate and development are intimately interwoven. Sustainable development offers a much more attractive form of growth than the past, and of course climate can derail development. This is the growth story of the 21st century if we get it right. It is not a simplistic, static story where somehow the economy that we might think of as normal is separated from this global public good. That's a very sort of static, naive way of looking at this story. This is a story of a new form of growth. It's a dynamic story. Climate is not separable. It's not some sort of voluntary add-on to the standard economy. The scale of the investment will be very large. Larry and Mark both emphasized that. Order of magnitude 2, 3, 4% of GDP sustained through this decade and all the way to mid-century. To draw that through will require strong policy, micro, structural, and macro. The first responsibility for these policies lies with our ministries of finance, our ministries of economies, but of course central banks, for the reasons that have been covered well already, have a very powerful role to play in managing the potential instabilities. The financing gap is big. Outside China, we're talking about $1 to $2 trillion annually of extra resources over this decade and beyond. Domestic resource mobilization will be crucial, but because the fiscal headroom for poorer countries is under strong stress, we do need the development banks to ramp up quickly and stay at a much higher level for this decade and beyond. If they do it right and on the right scale, it will be enormously supportive and indeed multiplying for what the private sector can do. So how can we best mobilize these funds? Well, stepping up the development finance institutions and describing how they work, both Larry and Mark covered that, and Nirmala. It's managing, reducing, and sharing risk so that those private sector multipliers can be much stronger. But it is also channeling concessional funds for key parts of this story. The just transition, which Nirmala surely rightly emphasized, the dislocation that's going to come from moving so quickly will require some concessional funds, which it's crucial that are forthcoming in large measure from the international institutions, but also, I think, from the voluntary carbon markets, as Mark has emphasized. The platforms that Mark described, the climate finance leadership initiative, Fast Infra, GFAM, are all very important. Voluntary carbon markets can play a very powerful role as well. That's a crucial part of the story. And we have to remember that central banks are not just about stability, they're also about their own portfolios and market operations. As far as climate goes, current market prices are not neutral. Climate is not yet in the markets, and it's crucial that we recognize that acting as if the markets are neutral is to make a serious mistake and to be seriously biased. So let me conclude then. This is about economic policy as if time matters. This is not about comparing two equilibria and suggesting that the second is better than the first. It's about systemic change in energy, transport, cities, land. You don't get any systemic change just through the carbon price, even though the carbon price should be at center stage. Delay is really dangerous. We have to think and we have to act at the same time. And remember that distribution is crucial to this sort of policy challenge. So let's go beyond the static version of global public goods. Let's go beyond the simplistic separation of growth and development on the one hand and environment on the other. They are interwoven deeply. This is a time for action and sustained and committed change. It has to be on the scale that Mark, Larry, and Nimla have defined. This is investment with a clear, strong purpose. It's the growth story of the 21st century if we get it right and act quickly, and we're deep trouble if we get it wrong. Thank you.
Thanks very much, Nick. And I think underpinning all our speakers' perspectives was the point that financing the global commons is fundamentally not about overseas aid. It's not about helping some other people. It's about collective investment with immense returns, immense social returns for everyone, rich country or poor. So Larry's 100-to-1 return is really a return that all countries stand to benefit. Or if you like, it's the avoidance of financial calamity over and over again that we've got to invest today to avoid. There were a couple of points from the previous session which we ported over to this current one. And Mark, you might want to start on it very briefly. The issue of, we need a transparent carbon price. And the question which Bill Winter posed is that, should the task fall on governments or should the private sector drive it? Roger Ferguson has a similar point, which is, do you go for taxes set by the bureaucracy or do you have markets set the price of carbon? And you've already spoken about the potential for carbon offset markets, Mark. Is there a further focus point you'd like to make on this set of questions?
Yeah, I'll make 3 quick points on it. The first is that there is a difference, as many know, between compliance markets, so market price on carbon versus credit markets, or also called markets for carbon offsets. So those prices will be different. There's different characteristics. Nick alluded to this in his comments about co-benefits of carbon offset projects. So think of some nature-based solutions, reforestation with biodiversity that is helpful for those broader nature reasons, and also for indigenous peoples and others is different than monoculture reforestation, for example. So there is quite a bit of complexity there, and that's part of the market design for carbon offsets versus just straight carbon mitigation compliance. So I would make that distinction. The third point and my final point is, and again, Nick went to this, but when one's looking at deep decarbonization, system change, carbon price is complementary but not decisive. And so you need broader sets of measures, and we see it in the energy transition or the volatility in the near term of the energy transition, which is not consistent with broader transition system change that's necessary in order to go there. So it can be complementary in that regard, and you need other measures.
Thanks very much. Lyric Hale had a question about, given the enormity of the challenge, should we be imposing layers of costs on companies, regulatory reporting, etc., that could be costly and perhaps inflationary, or should limited resources be instead used to fund game-changing innovations, such as geoengineering and carbon emissions reduction? It's not either or, but any quick comments? Nick, you want to say something?
Yeah, it absolutely isn't either or. We've got to push very hard at R&D. We've got to think about how we transform our land and our cities, and that will involve very strong issues around design, standards, regulation, public investment. We know that the climate is not yet in the markets, and important work by economists at NYU, Philip Hildebrand, and elsewhere. We know that carbon pricing and risk is not yet in the market, hence the regulation of the kind that Mark Carney's been behind, the Task Force on Climate-Related Financial Disclosure, is absolutely fundamental to what goes on there. The scale of the change we need and the nature of the change we need, and the change in all the systems that count, mean that you've got to push on all those instruments and activities at the same time. And we've got a good idea what to do on each of those dimensions.
Thanks very much. Larry?
I'm going to make 3 points. One, I think I remarked to the divestiture advocates at Harvard this week that they seemed awfully focused on reducing the supply of fossil fuels and not very focused on reducing the demand. And in light of the fact that energy price inflation was a major political problem, they might want to think about their orientation in a profound way. Second, Nick and Mark are larger experts on this than I, but I have been persuaded by the work of my Harvard colleague, David Keith, that an ultimate solution here is going to require going beyond containing emissions to technologies that either remove greenhouse gases on a substantial scale or shield us from greenhouse gases on a substantial scale. And I think it's not too early to begin thinking about the development of those technologies. That's happening, but also the financing of the deployment of those technologies. Third, I have had a uncharacteristically large for me change in view on one aspect of this in the last several years. A few years ago, my view was if you got the price of carbon up and right, the rest would take care of itself. And if you didn't, it wouldn't. And that was where most of the issue was. As I have now studied everything going back from removing smog from Los Angeles and London in the post-war period to the US sulfur oxide programs, to the chlorofluorocarbon removal, every time the world commits itself to do one of these things, almost without exception, the costs end up being substantially lower than it was originally expected that they would be. And so technology forcing is central to effectiveness here. And as we think about policy, that needs to loom larger than traditional economic thinking with its emphasis on the Harberger triangles and so forth. I don't have a fully worked out view of just what all the policy implications are for that program, but I think it is something that is very important to keep in mind.
Yeah, excellent point, Larry. Mark?
I'll just pick up on Larry's last point. You look at policies such as moratoriums on internal combustion engine vehicles from 2030 in the UK, 2035 in Canada, mid-2030s in a number of European countries. That is a technology forcing policy given the scale of those collective markets. And guess what? What's happening is that there's enormous investment in all of those jurisdictions in the entire supply chain for zero emission vehicles, which goes to the point to go to Lyric Hale's question. Actually, I actually think the premise of the question is wrong on both accounts. One is implying that this transition is a drag on growth. It's actually a multiplier on growth. There's ample evidence on that. Provided you get these policies right and you have some forward guidance and you have the financial sector able to allocate. Last point, the financial sector cannot allocate properly without this fundamental base of information, which needs to be consistent across, and actually having common mandatory reporting globally, or at least through the G20, which is what we're going to get, is what gives us that. And then connected to that, having a visibility on potential transition paths. Of course, the market's going to figure out the right transition path in that context.
Yeah,
thanks.
Simon, just to add very quickly, you're not picking winners here. You're regulating out the disasters. And think of the incandescent light bulb. We regulated it out in Europe very fast. Other things came through. We knew something was there. We didn't know exactly what it would be, but that is not picking winners. It's regulating out the deeply damaging, risky, and then the market can function very well, particularly if you get behind the R&D.
Thanks. Well, I think we'll have to round up here. We've run out of time, but Starting from Minister Sitharaman's broad overview of the challenges internationally and using India as an example of what we have to do time and time again when we face these crises, extending through what the other speakers have said. One is struck by the sheer scale of the challenge and the fact that we're not going to be able to resolve it through traditional means. We do have to reform the existing organizations. We do need new mechanisms to mobilize substantially more finance from the official sector, but in ways which, as Larry says, are actually affordable country by country. We do need to catalyze a lot more private finance and mobilize the power of private markets in incentivizing action by firms. And we do need regulation, both for pandemic security as well as for climate security. And that combination is inescapable. And each of them require much bolder action than before. So I'll just conclude on that point and to thank Nirmala and all our speakers for joining us this morning. It's been a useful discussion. It won't be our last, but there are some important thoughts that came up today that we have to follow up on. Can I now turn to Jacob, who's together with me co-chairing this panel, for some final words? Jacob?
Thank you. Thank you very much, Tharman, and thank you very much for all these dynamic presentations. I must start with one word, wow. I mean, we have had an unbelievable race of the best cars in the world, of the best presentations, the best speakers, and most important relevant topics, one after the other. And we thought initially that we have two panels, and the question was how to connect them, and it's so obvious. They all focused on the same issue, each one from a different perspective. Of course, climate came to the fore, externalities came to the fore, uncertainty came to the fore, policy came to the fore, vaccination came to the fore, etc. So I would say that we have had not just presentations about what has happened, but also fundamental changes of approach about what should happen. And I will not start summarizing each one of them separately, but I can tell you that there is here a complete new agenda for economic development, a new agenda for policymakers, and a new agenda for international financial and organizations, a new agenda about the role of them, and a new agenda about the financing of them and the time perspective. And I must say, those presentations illustrated how critical a good economic analysis is for these topics. It is the notion of public goods, the notion of externalities, the notion of missing markets, the notion of pricing those kind of things. That's the key. Otherwise, we will not make progress and we will start walking around where we are. I think that one of the lessons that any listener or watcher of these presentations draws is that the new equilibrium is not around where we are now. It is far away. And as a result, marginal changes will not bring us there. And it's not, let's start marching from where we are in a gradual way of the rhythm of a snail or of a policymaker, but rather we need really to define the new equilibrium and ask completely fresh, how do we move from here to there? And will the Bretton Woods organization meeting that took place so many years ago in New Hampshire, would they design the system of today in that way? I still think that we learned that it is critically important to have those organizations, but it is also critically important that they evolve in a dramatic way because the world has evolved in a dramatic way. And there is a long gap to make up for because it was not done in the previous years. So I think that, again, this is the main lesson that I draw. So let me thank again all of those fascinating presentations, and I join you, Tharman, And I must also thank you for these efforts. And now let me make a little bit more a G30 administrative, either announcements or statements or whatever way you call it. We have published in the past year several reports, and I want to point out two of them, very important ones. In May, the group released the sovereign debt and financing and recovery after the COVID-19 shock, the next steps to build a better architecture. So in other words, we are already looking at the next step. This study was led by Larry Summers and Guillermo Ortiz. And there is also another publication that came out recently, and it has to do the role of sovereign debt and COVID-19, and it has dealt with, well, by the end of July, by the way, we have published the US Treasury markets next steps to increase resilience. All of those are critical issues. That latter study was led by Tim Geithner. There are significant recommendations there. It is all on our website, and we all encourage you to look there. Of course, the group is supported by a very large community of institutions, and we appreciate more than 100 institutions, public and private alike, that are supporting our work. And the presentations of today were a good illustration. The G30 has a Twitter account, Twitter, which is at Group of 30, and there is a lot of stuff over there. I encourage you to do this. I will not complete my role if I neglect thanking those who actually carried the work throughout the year. It is the G30 staff: Stuart McIntosh, Desiree Maruka, Emma Prohl, and Melissa Golding, for all their actual ongoing efforts to make these type of meetings a success. We have been doing it this time remotely, and I think, however, the dynamism has demonstrated that this is not a fatal problem. However, there is nothing better than to tell you at the end of the session, we meet together for drinks and a small thing that normally the Inter-American Development Bank is providing us. But this time, we will stop with this dietary reception. I will only tell you that next year, the IBS will be scheduled to be hosted by the Bank Al Maghrib in Marrakesh, alongside with the IMF and World Bank meetings. And it will be fantastic when we will be able to say that the COVID situation is enabling us and the international financial system to host us over there, and in particular with all the kind of revolutionary programs and plans that were indicated today. So for all of this, I would like to thank you again, and Tharman, I pass the baton back to you, and thank you for running it so well. Thanks again.
Thanks very much, Jacob. Extremely well put, including your points about if we were starting again, or we were starting today, we would design the Bretton Woods institutions quite differently. Thank you very much. Thanks everyone for participating, and look forward to seeing you again before too long. Bye-bye.